So the funds I focus on creating right now are single asset funds. So the asset is already identified and we are only creating the fund to invest in this particular asset. So investors know what they're investing in and we're all good.
Welcome to the Real Estate Mindset Podcast, hosted by Eric Nelson and brought to you by Wild Oak Capital. Eric is a real estate investor, business owner, and performance coach. Throughout this series, Eric explores the mindset behind why certain investors are so successful and how we can learn from their achievements and failures. Eric asks the tough questions around the habits, discipline, mindset, and more required to achieve the most ambitious goals. Thank you for being here and enjoy the show.
Hey, everybody. Welcome to the Real Estate Mindset Podcast. This is your host, Eric Nelson. Have another awesome guest. Super excited for this. So Lisa Hylton, thank you for joining me. Thanks for taking the time.
Yes, thank you for having me, Eric. I appreciate it.
So I have a mountain of questions for you. So we'll just start with the beginning though. Tell us where you're from, your background, and then what kind of led you to real estate.
Sure. I'm originally from the Cayman Islands, but I live in sunny California, Los
Nice.
Angeles. And my background is accounting. So I went to school for accounting, qualified CPA, spent 10 years in public accounting, Big Four, and then 4.5 years working for a large investment manager in the Los Angeles area as a controller on private equity real estate funds. And these days, I work full-time in my business. My focus is building my business, lisahylton.com, that provides opportunities for busy entrepreneurs and professionals to invest in tax-efficient real estate opportunities.
Okay, I like it. So we were kind of talking the pre-show, and I halted my questions because I'm so excited to ask these. So can you explain, first of all, how your business works and how people could get involved? And then we'll dive a little deeper into that.
Yes, great. So I'm a fund manager, essentially. So what I do is I build relationships with great expert, world-class operators who are at the top of their game in terms of what they do, investing in the real estate space. And I create a fund, right? These days, I focus on creating single asset funds to invest alongside them. And then with that, investors can come into my fund and get into these different opportunities. So the funds are either for accredited investors to the extent that the opportunity with the sponsor is only for accredited, then that would dictate for me to only allow accredited investors into my fund. And then if it's a 506B offering for sophisticated as well as accredited investors, then it would only be open to people that I have previous relationships with.
Okay, cool. So a couple questions. I know that we're not attorneys, but just for our listeners, this is good stuff. I mean, I think the difference between 506B and C is extremely valuable. So if you don't mind, can you elaborate a little bit? And then I'll ask some follow-up questions about the funds, of course.
Yeah, so 506C offerings, this is under Reg D, which enables Dodd-Frank Act that allows, the raising of capital and the exemptions surrounding real estate syndications. So the exemption for the 506C offering allows you to only raise capital from accredited investors. And accredited investors are defined as single people that make at least $200,000 a year for the past 2 years and are on track to do that this year. And then for married, it's 300,000 for the past 2 years on track this year, $1 million in net worth, or you have like the Series 65 and I think 2 other licenses. If you have those, that could enable you to be an accredited investor as well.
Yeah. Okay. And is the net worth different for a couple or a single person?
Nope, it's the same.
Okay, cool. So if a couple makes, 50 grand each and they have a net worth of over $1 million, they would be considered accredited. Okay.
That's right. Yeah,
cool. Love it. Yeah.
And then sophisticated are typically, investors. One, you need to have a relationship with this person. So it isn't someone that you just met today and now you're presenting them a deal tomorrow. So you've gone through the process. You understand their investing goals, you understand their financial situation. And then now, typically I like to do like a 30-day sort of cool off period to build that relationship and get to know them to then before presenting a deal. But that's the way I approach it.
Right. Yeah. And it's a little vague um, in that it's kind of like a substantive relationship, I believe is the language they use. And so it's kind of like, yeah, how do you define that? But no, I mean, I really appreciate you recapping that. It's kind of my understanding as well. And it's so good for people to understand what that means because it can seem like a lot of jargon, but it's basically you can invest in some of these deals regardless of what you make. You just need to be sophisticated and understand that there's some risks involved. And so it's super exciting. So let's come back to what you do.
Yeah.
So when someone says, hey, how can I get involved? Describe, if you could, the difference between a syndication and a fund, and then what that looks like for an investor.
Yeah. So syndication and funds are typically the same. When they work through someone like myself, I just have um, relationships with the different operators. They could, to the extent that they have the relationship directly with the operator, then great. They could potentially invest directly if they had that relationship with the operator. So that's sort of how that works. And then in terms of like how the funds are structured, like if people, I think maybe where you're leading is maybe like whether people would get a different return going through, like, say, a fund that I created versus them meeting the operator and going directly with the operator. So for me, at least, I've been able to keep the returns the same. One, with a couple through a couple ways. So there's three ways you can keep the returns the same. Actually, two ways. The first one is you decide to foot the bill for the PPM, as well as the preparation of the K1s for your investors, because your investors would get a K1 from you and your entity would get a K1 from the main sponsor.
Understood.
So
Okay.
yeah, so like you can decide that you are going to foot the bill. I've met syndicators who've done that, so that's an option. Or you can negotiate with the operator and sort of say, hey, you're bringing a million, 2 million to the deal. Can you give my fund better terms? And from doing that, that can also enable you to then, have enough money to pay for those things. The third option would be to actually would impact returns. So there has been situations where people have created funds and the return is slightly lower, especially if you're doing like a 506B offering. This could come into play because like individuals do not have a relationship with the operator. There's no way. They're not accredited. It's not like as though it's a 506C offering. So if they really like the deal, then they'll come into that, and they still get really good returns nonetheless.
Okay. So I know I'm kind of diving a little deep here, but this is actually really good information. Um, so if you have a relationship with the operator, it's a 506B raise, and you can have a fund, and that fund basically could still invest even if the people who are funding the fund don't have a relationship with the sponsor. Is that
Correct.
correct? Okay.
Correct. Because
So they
they have a
basically,
relationship with you.
okay, got it.
And
So
it's
it's like
their
this layered thing. It's like
correct.
your fund has a relationship with you and you have a relationship with the sponsor, and so it kind of all works. Okay. Cool. So that's actually um, that's kind of a neat way to get involved. So what would be the benefit? Is there any benefits in being in a fund? So let's say you know the operator.
Yeah.
Would it be more beneficial for you to invest directly with that person, or is there any benefit in being in a fund? Like if you're an investor.
Yeah, I think it just sort of depends. Like, for instance, you could have, like, say, a 506C offering. So, yes, so 506C offering, my fund, for instance, could have a lower minimum. So,
Oh,
like, the
understood.
operator might be wanting 100K or 200 for their minimum. And I might decide to have a 50K minimum or a 25K minimum. So that's how typically the accredited space could work. And then on the 506B offering, like, yeah, like if they have the relationship directly with the operator, once again, the only differential would be the minimums, because you might decide that you just don't want to put that much into a deal
Got it. Okay. Okay.
for whatever reason.
Okay, so do you actually are you a GP or sponsor on any deals? Or you is your kind of main focus having funds and then bringing those to the deal?
Yeah, that's a great question. So I'm open to being a GP on deals for sure. I am definitely open to doing that. Uh, a lot of the opportunities that have come my way so far have been these fund type structures. Um, and there's also SEC rules and stuff where when you have multiple people bringing capital to deals, um, just trying to understand what the rules are for all those different people. So
Understand? Yep.
that's the part that gets a little bit tricky. And when you talk to a lot of attorneys in this space, syndication attorneys, they tell you that the fund model is one of the safer ways to protect yourself to the extent that you are not a broker dealer.
Interesting. Okay. I mean, I love this. It's such a cool concept. So the question I asked before, and I am excited to hear the answer. So a lot of people I think that I talk to shy away from the fund idea because they say, well, what if you raise this fund and you have this capital and you can't find a deal?
Yeah.
Do you delay funding, or how does that work?
That's such a great question. And so, couple different things. So, that question applies to a certain type of fund. So, the funds I focus on creating right now are single asset funds. So, the asset is already identified, and we are only creating the fund to invest in this particular asset. So, investors know what they're investing in, and we're all good.
Okay.
However, there are other types of funds. So you have blind funds, which typically would fall into the category that you're talking about. So these blind funds can show up in a variety of different ways. They can be evergreen funds, which I can say what that is. Those are funds that are just going on and on and on and on. And then you also have close ended funds. So these closed ended funds typically have a set period of time for which you're going to raise money, a set period of time for which the investment manager is responsible for deploying the capital, and then they usually have a set period of time for when the fund should be wrapping up. Usually it's about 5 to 7, maybe 7 to about 10 years. So the funds I worked on were generally close-ended funds that fit that category. So they usually have about a year and a half or so to raise money to get to their top commitment, usually like $1 billion raise. And then once they hit that, they close the fund, no more investors, and then they usually have about 2 years to invest that capital into deals. And then once the investment period ends, uh, they they can only invest it in deals that they've identified. It's almost like a 1031 exchange.
Okay.
You can only invest like in the deals that you've identified. So even if you haven't invested in all the, like you have, I don't know, maybe 600 billion left to invest or something, and you've identified, okay, these four other deals is what we want to invest this money in, but we're still going through underwriting and still going through all of that process to determine whether we want to go forward or not. And then once they do that, then there's really no more investing. And if they want to invest more, they need to like sort of reach out to investors, communicate that, go through the legal process to get it signed off, and then they could potentially invest in more deals. But the fund space is extremely creative. And then to answer your question specifically, so when you have a situation where you take money from investors in these blind fund scenarios, what I am used to seeing is that the preferred return typically begins the moment you call capital.
Got it. So they have a preferred return, and let's say they don't make any money in the first year. It's like a standard waterfall where they would have to pay that return back over the years as they make it. Is that kind of accurate?
Yes,
Okay.
exactly.
Okay.
Exactly. Because you're gonna pay preferred return first,
Right.
and then you return investors their capital, and then whatever, if you have like, okay, you need to hit 15% IRR, or if you have a catch up, it can get very complicated, but like whatever kind of terms you have after that, the most simplest is just a split, 70/30.
Right. That's the same as syndication, right? Hmm.
Exactly.
Okay. So I'll ask the tough question. What's the upside for you? Like, what do you get from raising the fund and bringing so much capital, other than being part of the deal? But I mean, you could just invest with that sponsor. So why all the effort to raise the fund?
Yeah, for me at least, I think a couple different things. Like, um, by you creating the fund, like you do by you have that compensation. I wouldn't call it compensation because it like that's illegal, you know. But like being able to negotiate better terms for your particular fund, it's almost like you being one investor, like a family office. It's like creating a family office for people that you know. Like that's pretty much sort of like what is happening. Because when a family office approaches a big sponsor, they can then negotiate for better terms, and then through that, some of those they can then determine, okay, how much of that they're going to give to their investors and how much they will then retain for themselves.
Okay. So you can actually, so I know I'm getting really in the weeds here, but I just want to try and understand. This is super cool. So let's say, I mean, let's use some round numbers. So let's say that an investor finds a syndicated deal, they need to raise $3 million, and you say, hey, I can bring a fund of 1 million.
Right.
You could negotiate better returns for the folks in your fund, one,
Yeah.
and then two, as the fund manager, can you actually, uh, determine how much? Is it kind of like a syndication within a syndication, whereas in the
Yeah.
sponsor gets a little kickback? Okay, so
Yeah. So
so
you
you
could charge fees at your level. You could, like,
okay.
I have the ability to do that.
Got it.
You
Okay.
could do like, you could say, what, the GP in my fund is going to be 5% or 2% or whatever.
Got it. Okay.
And as long as you're clear about that and you tell investors what the returns are and they're okay with that, then that's, that's what it is.
No, I mean that's amazing. I mean, I think this is such a cool concept, and it's amazing you don't hear more about it. I mean, for some reason, this is not talked about, at
Yeah.
least from what I know, very much. So this is really cool.
Yeah. Yeah.
Wow, what a like a cool way to get involved, and then you can, just like you said, you can handpick the sponsors that you like to
Sure.
work with, and then you can say to investors, hey, I've selected the folks that I think could do the best job. So, um,
Exactly. And to build on that, you could also, like, over time as you continue to grow and build more relationships with more sponsors, you could create different types of funds. So, like, you could move away from single asset and move towards, say, I am creating a multifamily and self storage fund, or a recession resistant fund that is only going to invest in certain types of assets that are known to be recession resistant. So, like mobile home parks and self storage and stuff like that. And the benefit to the investor is that when they put 50K into that fund, they are now getting exposure to multiple assets as opposed to just one.
but the funds that we were talking about previously has a selected asset, right? So we're talking about two different things. So now we're kind of moving on to a fund that could invest in multiple things.
Yes.
Okay. And so we come back to that question is, let's say you're in that fund, and the manager, let's say yourself, is running it. What if you can't find a deal? I imagine it can get pretty expensive. That preferred return starts packing up, right? So you almost are pushed to find a deal if that fund is live, right?
Sure.
Okay.
Or you could be in a situation where, like, for instance, I've seen recently where people could be buying a portfolio.
Got
So
it.
there could be like a portfolio of 25 multifamilies. And that, like, that's just insulating you. So you now are getting instant diversification on your 50K as opposed to just investing in one asset.
Cool. And so, and then as a syndicator, if someone says, "Hey, Lisa, can you create a fund for this deal and bring some capital?" I mean, I think that is a huge benefit for folks as well, right? I mean, is that the response that you see?
Yeah. So because there are lots of deals out there, unlimited amount of deals. And there's also a lot of money out there too. It's just finding, they want to find each other and they want to find the right people to invest with. And like spending that time to get to know sponsors. Many times, people who are, professionals busy working long hours, they don't have time to be networking with, all these different operators and sponsors. So that enables them to be in a situation where they want to put their money to work, but would like to be able to trust someone who's going to be able to go out there and do that, do the due diligence, get to know people, help them in terms of teaching them about different asset classes that they could invest in that they're just not aware is even possible. So,
Cool. I mean, this is so cool. So again, we kind of talk about SEC rules.
yeah,
My perspective is in a syndication, you can't just raise money. You can't just
right.
be raise money and then get a kickback for that. So that's illegal, right? And you have to be a true GP. You have to be involved. This is, I mean, for lack of a better term, it's similar, but it's legal, right? And you could actually get uh, a, a percentage because you raised all that capital, but you're not truly a GP. Is that
Correct.
accurate?
Correct.
Okay, so that's
That's correct.
okay. And is there
Yeah.
any more hurdles SEC wise, or you have to have
I
a
was gonna
PPM specifically for the fund as well, correct?
Yes, you do.
Okay,
I was going to say that you can raise money for deals. You just need to be a broker dealer, a registered broker dealer,
right. I have a license
right?
for
And you need to go through that process. And there are people who've done it, so it's possible.
it. Anything's
I've met
possible. I just
them.
maybe it's just me. I'm pretty afraid of breaking SEC rules. I
Oh
don't
yeah.
really want.
Oh yeah. Oh yeah.
No, no. This is cool because you're exactly right. I mean, I think most people who have a little bit of capital,
Right.
they want to put it to work, and this kind of brings us the segue into why why real estate. So before I go there, I just want to expand on this a little bit. Is you really want to work with someone that you know and trust, and you don't have the ability to really get to know operators, just like you said. So if you find someone like yourself that they're investing with you, chances are if you bring them returns, they're going to continue to invest with you. So it's such a unique, very, very cool way. And plus, you're not necessarily having to do the struggle of finding the deals. You can just partner with good operators who are, far enough in the game that they get deals and stuff like that. So this is a really cool idea.
Yeah. Yeah.
So brings me to that question back is why real estate? I mean, why it sounds like you have a pretty unique background. You have a lot of knowledge. So why do you select this space?
Yeah. I think so. For me, I grew up in real estate. My father was a contractor and built 14 apartment units. So I'm very familiar with like real estate as an asset class. And I would say that my resurgence back to real estate was when I took this job working at the investment manager. Because then I had purchased the property when I was much younger in my early 20s in Cayman. And the property broke even the first year and lost money every single year after that for about 6 years. And during that time, I lived in Cayman, Boston, and then Los Angeles. And after a year of living here, I said, you know what? I got to get rid of this property. It's got to go. It's got to go. And I was like, no more real estate. And about a year later, I started working for the investment manager. And I was like, wow, like, this is pretty amazing. Like, I had no idea, like, people could lose money. Like, I knew people could lose money. I could see sometimes some deals didn't go very well. But then there were other deals that went extremely well. So it started from me thinking very small, to be honest. It was just like, oh, I just want to buy a duplex to live in and like rent the other side and maybe buy some single families, to then being introduced to multifamilies, and finding out that it was possible to invest in these kinds of deals as a limited partner. um, and that I wasn't an institutional or high net worth investor. And I was like, wow, like I thought the only place that you could get these kinds of opportunities was like where I worked. And then when I was introduced to the fact that you could invest in this otherwise, I was intrigued and I learned more. And the more I learned, I was like, okay, wow, like this is pretty amazing. I think like I was also very entrepreneurial. So when I saw the opportunity for the business as well, I said, well, this would make an amazing business. So yeah, that's
No, I
that's
mean,
how I got into this whole web of real estate.
yeah, it is a web. I mean, the more you learn, the more you need to learn. It feels like it's It's awesome. So I feel the same, and it's interesting that you would describe it that way because I have a similar uh, a feeling. Is if you're someone that has some cash and you want to invest, there's so many ways, but for some reason we're just coached to do this 401k thing
Yeah.
and just kind of do the employee match or whatever, and it's kind of this mindless thing. You don't even get to select typically very much of what you're invested in,
Right.
and the returns, in my opinion, are just nowhere near real estate, nowhere near safe. The tax benefits aren't there. I mean, it's just, you could go on and on and on. But for some reason that it's a lot of corporate America is that way. But instead, hey, you can invest your money with someone you know and trust, and the returns are, if someone's doing a good job, are just better.
Yeah, 100%. And I feel that, one of the biggest things is there are a lot of people who are unhappy working some of these corporate jobs. And they might not necessarily want to be full-time real estate investors, like, managing properties and being landlords and whatever, but they might want to have the freedom to maybe, start a different kind of business or explore a different type of career opportunity that would be different from the one that they're currently in. But it would require them to give up maybe that six-figure income. And that's where, like, making these kinds of strategic investments in real estate investments can help you to sort of bridge that gap. Because for me, at least, I've invested in five syndications to date, and that has really helped me in terms of making the transition from W2 to corporate. Sorry, from W2 employee to entrepreneur.
Awesome. Well, let's talk about that a little bit. So, explain your journey to, people use financial freedom or whatever you want to call it. Your
Yeah.
journey quitting your job to where you are now. I mean, can you describe it a little bit? And are you glad you did it? Is it scary? I mean, all those questions.
So it is scary. There's no
uh,
doubt about that. For sure, it is scary. However, I think it was gonna be even more scarier to stay than to leave. And I think that sometimes in life, um, you need to make some of these types of decisions because it puts you in a place where you start thinking differently, which I know your show is actually about mindsets.
yeah, I was just gonna say
Goes
that.
nicely to that. Like,
Yeah.
you start thinking differently about stuff because you have to. Whereas, when you have the direct deposit coming in every 2 weeks, like, you're comfortable, for lack of a better word. And sometimes you just won't take the things, you won't do the things you need to do in order to move forward. And I think, yeah,
No, I mean that's so well said. And I love what you said. Is it was, yeah, scary, but it's scarier to stay. I mean, that's like such a good quote, because people do. I have. I mean, I was this way, guilty of it as well. It's like, well, one day, one day, one day, one day. It's like in the future, I'll be able to save for retirement. So, I'll make more money next year and I'll save it. And then,
right,
this perpetual thing. Whereas if you actually take a step back, think bigger and say, okay, what actually needs to take place for me to not be in this chair, if that's your goal? And, you
right,
know, there are people out there who love their job. And so we're probably not talking about them, but for
right.
people who want to leave that or maybe do something different and have some supplemental income, this is a great path to do that. And it's actually a pretty clear path. I mean, you can actually see, here's the road to returns as a passive investor. And by the way, you don't have to do anything. You just like
Exactly.
invest your money, and yes, it's a risk just like any other investment, but it's pretty sweet. And the returns typically, if they're operating well, are there, and then you have this supplemental income. So love it. I didn't mean to go over that, but I just think that your words were so good.
Yeah, and I've met people who are full-time passive investors, so they're definitely out there, and I get really excited when I meet them because it's like, wow, like, they're people who have been able to build a gigantic portfolio. And it took time. It's a multi-year strategy, but I think that once you figure out that this is what you want to do and you start investing, like, sky's the limits in terms of like what can happen. But connected to your question in terms of how I got prepared, for me, the easier part of getting prepared was financially. So everything from, funding my HSAs, so doing health insurance plans that come with the health savings accounts. So that way, I had years and years of compounded health savings, and using like investing that money into the market, and just keeping on can enough for the deductible. So by the time I got to the point at which I was gonna leave, that like I had enough. So it's like it's okay kind of thing.
Mhm.
And then investing, in real estate syndications helped me a lot. It helps me now because like I can continue to focus on building my business. Um, I know what it's like to be a passive investor. It helps me to be able to, walk in someone else's shoes when I'm, presenting a deal to them that is going to require them to invest 50K or, whatever amount. Like I know what it's like to write those checks because I've done it.
Yeah, no, I mean, it's super valuable. I have
Right.
I think lots of people go that way. They started an LP and then they move their way to GP, and it's really cool because just like you said, you could walk in their shoes. So
Yeah.
awesome.
So yeah, having that experience, choosing about 3 years ago, I decided to move to an apartment that was in a more economical part of town. So like things like that has helped me to like really hone in on my burn rate, like how much money it costs me to live each month. And I, you know, on the personal side, like I tried to date as much as I could. And it wasn't really lining up, and I said, you know what, maybe because like I need to just go take this leap. So so yeah, like sometimes you find yourself in life in a situation where, I'm in my late 30s, and well, mid to late 30s, and I was like, you know what, this is as good as the time is going to get. Like from here on out, it's going to get even harder, like, to the extent that I get married and have children, and it would just be a lot more challenging to make that kind of decision at that point. So I said, you know what, why not, let's just try it. I also hired a coach, and my coach really helped me to, take that push, because she was just like, what if you just took 12 months? If you're financially ready, what if you just took 12 months? And the hardest part was the second part, which is mindset. So hard.
This is that's a perfect segue, of course. But I'll let you finish.
Yeah. So mindset is the hardest part. It's just hard.
Mhm.
So yeah, I'm happy to dive into like what I do these days to keep my mindset
Okay.
in top position.
Cool. So here's what we'll do. We'll just segment right into that section. So I have a list of questions that I ask everyone on the show, and then after that, we can just talk mindset forever, and we can hit stop record and just keep talking. But um, that way, if the questions kind of go into what you want to talk about, it's kind of nice because I like to have that segment. So
Sure.
if you're okay with that, we'll just dive in.
Yeah.
Okay. So the first question I ask is, do you have a morning routine?
Yes, I do. So my morning routine, is one, meditation, two, journaling, and three, working out. And then
Awesome.
I'll start working.
No, I think I'm a fan of whatever routine works for you. I asked that question, and the answers all across the board. It's kind of an interesting question though, because most people, I think, who place value on mindset will say yes in some capacity. It's yes, I get my mind right, my body right for the day, and it's the best way to tackle the day, in my opinion. So to each their own, but love that answer. Next question would be, what books are you currently reading, or what books can you recommend to our listeners?
Yeah. Oh my goodness. I love it. I love it. So I am just finishing up The Magic of Surrender. And the last three books I finished reading was, Fanatical Prospecting, and The 12-Week Year, and Who Not How. And
Wow.
I
So this
highly
is an
recommend.
awesome list.
Yeah,
Yeah.
I highly recommend all three. Like all of these books are just so good. Out of the 12-week year, I created my own weekly accountability meeting that meets every Monday. It's me and three other people. We keep it really small and other entrepreneurs who are full time in their business. And it's been just so good to have that meeting every week. It's just so good.
Yeah, and I say this a lot. You can actually talk to someone who's in the same shoes as you and say, "Is this challenging for you too?" or, here's a win.
Yeah.
That's so cool to share that group. So I love those. I'm gonna write those down. I've heard Who Not How several times on the show. It's about time I read it. And then 12-week year, and then the other two. I mean, I've never even heard of them. So this is such a cool recommendation. We'll put them in the show notes, of course, for listeners to check out. So great response. Okay, so the next one is actually you touched on a little bit. Is do you have a coach or have you had a coach?
Yeah.
Sounds like you have. And was it worth your time or investment?
Yeah, 100%. And this is what I'll say to you is that I've had several coaches. But the advice I give to people is it's so important to get clear on how you want to play, because how you want to play will dictate who you need to hire to coach you, because they're going to coach you to where they are. And that's where they are needs to be coming from where you have decided within yourself is where you want to go. So in real estate syndication, such a large business, like you acquisitions, asset management, investor relations, the big key, anchors there. And like sometimes when people come into the business, like yes, it's good to know everything, but in order to really move fast, like the who not how, tapping into your unique ability and figuring out what role you want to play, and then finding the coaches that are at the top of their game in that role, and then you know reaching out to them to get that mentorship. But at the same time, I don't regret anything that I've done in the past, because every single encounter has helped me to get to where I am today.
Yeah, I mean that's amazing advice. It's super true. It's say, hey, find that person who's doing what it is that you want to do and who's excellent at it. And there's, if they're a coach or a mentor, then there's your best selection. I mean, that's great advice. It kind of goes alongside with start with the end in mind, and then kind of work backwards from there. But having that advice for a coach, great piece of advice. So this next one is, what's something that you've done that you would not repeat that our listeners could take away from that?
Um, Something I've done that I wouldn't repeat. Hmm.
You can say nothing. You say the journey's the journey.
Yeah, I don't think I
Okay,
have anything
that's good. I mean, that's
comes
cool.
to mind right now. Yeah.
No, I mean, that's actually a really cool answer because lots of times, yes, we all make mistakes, but a lot of times you can look back and say, well, that brought me to where, this and this and this. And so it led me to where I am. So very cool answer. We'll say nothing. Sorry, listeners. Gotta, just kidding. Okay. So then the next one is, what mindset tips can you give someone? That's kind of what you were touching on before. What mindset tips can you give someone who is just starting out?
Yeah. Whew. I would start with you need to be around the right people. So you have to find the right kind of people, masterminds. Getting around the right community of people is like super important to help you to grow. So I would say that's the first thing. And then the second thing is um, just cultivating a deeper relationship with yourself, to know when you are self sabotaging yourself.
Oh, that's so good.
When those negative thoughts come up, to be able to meet them with grace, and to know and to not have them stop you, because you don't stop the negative thoughts from coming. you sort of just have to deal with them and say, okay, I got it. Like, that's how you feel. All right. But I'm still going.
I mean, everything you just said is so good. So self-sabotage, big time. And I love your realistic output on negativity, because sometimes the positivity movement is just not reality. Everyone has negative thoughts and everyone has maybe disbelief or whatever it might be. But what you said was so good is basically set it aside. It's not serving you,
Right.
and you're gonna have them. To completely say you won't is just probably a lie. And maybe there's people out there. They're not me. I mean, I think everyone has those. So such good advice. I mean, that was an awesome answer.
Yeah.
Thanks for sharing.
Yeah. You're welcome.
And the next one would be this. These are tough for me. I think is how do you describe success?
Mm. Wow. That is a tough one. For me, where I'm at, I want to answer that from the perspective of where I'm at in my journey right now, and knowing that it's sort of like a disclaimer that maybe in the future I might have a different view. But for me, I think success is, for me, it's twofold. The first part is being able to take care of myself. Like, for me, I think that is a reflection of me being successful. Being able to meet my bills and being able to take care of myself is for me like grounded in the reality of success. And then the second part of success is for me at this point, I think is contribution. Being able to do work that feeds me on a deeper level. And a part of that is being able to contribute in a meaningful way in the lives of other people.
Oh yeah, amazing answer. I mean, I couldn't agree more with the contribution piece of it. I mean, um, that's to me is the ultimate piece of success is when you can improve lives however you do that. Um, so amazing answer. And the you kind of like touched on this a little bit, but the second part of that is if someone asks you why are you successful, what is your response?
Hmm. Two things, I think. Number one is discipline. Three things: discipline, focus, and just an unwillingness to give up.
Yeah, I mean, I hear similar kind of answers to those as people use the word grit. Unwillingness to
Yeah.
give up is like just stick to itiveness, like refuse to quit, kind of even if it gets hard because it always is.
Yeah.
Yeah, and discipline. So that's part of the reason why I asked the morning routine question too, is because I have this belief that um, true, lasting, uh, reaching your goals comes from discipline. So I love those answers. So that's I have some more questions in regards to funds. So we'll spare our listeners the details. I'll ask you those after the show. But this has been amazing. I mean, so many good tips, so much good stuff. So Lisa, thank you so much for being here. How can our listeners find you and get a hold of you?
Yeah, they can visit my website. So, one stop shop for everything, lisahylton.com. And that's Hilton like the hotel, only thing with a Y instead of an I. And yeah, everything is there. I have a freebie right on my website, which is Passive Investing Made Easy series. My podcasts are there, my blogs are there, and all kind of videos are there as well.
Okay, cool. So quickly before I let you go, can you describe that series? I saw it was a 7-day series. Is that right? So what could an investor expect from that?
Yes, they can expect to just get, for someone who is intrigued by the idea of real estate syndications and has not, like, they just don't know where to start. That course is built for them to just get an idea of what it's all about in an easy, simplistic way.
Cool. And so how long is it per day? 7 days, you said. How much time commitment do they need to put?
Great question. So it's 7 days, and each email has a video. The video is probably at max 5 minutes long.
Got it.
So it
Okay.
gives you bite-sized information about what a real estate syndication is, how the process works, etc.
Oh, no, I love that. I mean, because then it's not this crazy commitment where they have to take a week off of work or something.
No.
It's just like, okay. No, and I didn't expect that. I just want to be clear because that is a really cool tool. And I think that's really neat that you put that on your website. So I wanted to highlight that. So, Lisa, again, thank you so much for being here. Can't say thanks enough for your time.
Thank you. Thank you for having me.
Thank you for listening to this episode of the Real Estate Mindset Podcast. If you've enjoyed the content today, please follow this show wherever you listen to podcasts. And don't forget to head over to wildoakcapital.com for more information or to connect with Eric directly. Please take a moment to leave a review or tell a friend about what you've listened to today. We hope you'll tune in again soon.